Every great investor begins with curiosity, a question, a dream to make money grow beyond savings. You may have heard stories of people who built fortunes from the stock market. Maybe you wish to learn how they did it. Maybe you want to take control of your own financial future. The truth is, investing is not gambling. It is not a secret trick. It is a skill, a habit, and a mindset. Anyone can learn to invest. You do not need a rich background or a fancy degree. You only need patience, knowledge, and courage. You need to understand how money moves, how businesses grow, and how time multiplies wealth. This book will be your guide. It will take you step by step through the world of investing. From understanding the stock market to building your own portfolio. From learning about risk to mastering discipline. Each chapter will teach you something simple yet powerful. By the end, you will not just know what stocks are. You will know how to think like an investor. You will see the market not as chaos, but as opportunity. You will feel ready to take your first step with clarity and confidence. Let us begin this journey together. A journey from curiosity to confidence. From saver to investor. And it all starts with one simple question. What is the stock market? Chapter 1. Understanding what the stock market is. Before you become an investor, you must first understand the world you are stepping into. The stock market is not a mystery. It is a living system where people buy and sell small pieces of companies. These small pieces are called shares or stocks. When you buy a stock, you are buying a small part of a company's ownership. That means you share its success and its failure. Think of it like planting a seed. When you buy a stock, you plant a seed in the ground of business. If the company grows, your seed grows too. It turns into a tree that gives you fruit in the form of profit or dividends. But if the company fails, your seed may die. That is the simple truth of investing. The stock market itself is like a big global marketplace. In the past, it used to be a physical place where traders shouted prices and waved papers. Today, it lives mostly in the digital world. Millions of investors across the planet buy and sell shares every second through computers and mobile apps. The heart of this market beats with human emotion. It rises with hope and falls with fear. Companies list their shares on something called a stock exchange. A stock exchange is where all the trading happens. Some well-known ones are the New York Stock Exchange, the London Stock Exchange, and the Tokyo Stock Exchange. Every country has its own version. These exchanges are like giant stages where companies perform in front of the world's investors. So why do companies share their ownership? The reason is simple. They need money to grow. When a company wants to build new factories, create new products, or expand into new countries, it needs funds. By selling shares to the public, it gets that money. In return, investors like you become part owners. You share in both the rewards and the risks. Now, you may ask, how does the price of a stock move? The price goes up when more people want to buy it. It goes down when more people want to sell it. This movement is called supply and demand. Behind these movements are thousands of stories, hopes, and fears. A company's success, the economy's health, or even world news can make prices change in moments. But here is the key idea. The stock market in the short term is like a voting machine. People vote with their money, showing what they feel today. But in the long term, it is a weighing machine. It shows the true value of a company's performance. That means patience is power. A real investor does not chase fast moves. They study the company and wait for time to reveal the truth. The stock market rewards those who understand it, not those who rush into it. It is not about guessing what will happen tomorrow. It is about seeing what will matter in the next 5 or 10 years. You must learn to see beyond the noise, beyond the crowd. In the end, the stock market is simply a mirror of human life. It has moments of joy and moments of panic. It tests your patience, your courage, and your faith in your own judgment. When you begin to understand this rhythm, you stop fearing it. You start respecting it. And that is the first step toward becoming a real investor. So before you buy your first share, take a moment to observe. Watch how the market moves. Listen to how people talk about it. Study how companies rise and fall. Because the more you understand this world, the more power you will hold inside it. In the next chapter, we will explore why people invest, because understanding your reason is just as important as understanding the market itself. Chapter 2. Why people invest. Every investor begins with a reason. Without a reason, investing feels like a game of luck. But with purpose, it becomes a journey of freedom and growth. People invest because they want their money to work for them. They want their future to be safer and stronger. They want to break free from the cycle of only earning and spending. They want their savings to grow while they sleep. Think of your money as a team of workers. When you invest, you send those workers into the market to build wealth for you. If you keep your money idle in a drawer, it does nothing. It loses value over time because of something called inflation. Inflation means prices of goods rise and your money's power falls. So to stay ahead, your money must earn more money. Some people invest for dreams. Maybe they want to buy a home one day. Maybe they want to travel the world or start their own business. Maybe they want to give their children a better life. Each goal gives meaning to their investment decisions. Others invest for independence. They do not want to depend on others when they grow old. They want to retire early and live life on their own terms. They see investing not as greed, but as preparation. Preparation for peace, security, and freedom. There is another group that invests to build legacy. They think long-term. They want their money to grow even after they are gone. They wish to create something that can support their families or even society. They understand that wealth is not just about living better. It is about leaving behind something valuable. But here is the truth. Many people start investing for the wrong reasons. They chase quick profits. They follow rumors. They try to get rich overnight, and most of them fail. Because investing is not about speed. It is about direction. A wise investor thinks like a gardener. A gardener does not dig up the soil every day to check the roots. He trusts the process. He waters the plants regularly and waits. Similarly, an investor must plant their money with patience. They must let time and discipline do the work. When you understand why you are investing, your choices become clear. You stop comparing yourself with others. You stop panicking when the market falls. Because you know your goal is not today. Your goal is the future. Your reason becomes your anchor. It holds you steady in storms. When others run away, you stay focused. When others doubt, you stay calm. That is the quiet power of purpose. Some people invest in stocks. Some invest in mutual funds. Some choose real estate or bonds. The tools may differ, but the heart of investing remains the same. It is about building wealth step by step through wisdom and patience. In this journey, your first lesson is simple. Do not invest because everyone else is doing it. Do it because you understand what it means to you. Because your why will shape your how. Your reason will decide your path. In the next chapter, we will learn the importance of saving before investing. Because before you build wealth, you must first build a foundation strong enough to hold it. Chapter 3. Saving before investing. Before you invest, you must learn to save. Saving is the first step toward financial freedom. It is like building a strong base before raising the walls of a house. Without savings, your investment journey will always be shaky. Many people dream of investing, but they skip this step. They rush to buy stocks before building a safety net. Then, when a problem comes, they are forced to sell their shares early. That breaks the golden rule of investing. Never invest money that you may need soon. Saving teaches you discipline. It shows that you can control your desires. It reminds you that every coin you keep today becomes your soldier for tomorrow. Each dollar, each rupee, each euro saved carries a story of self-control. Start small. Even if you can only save a tiny part of your income, do it. What matters most is not the amount, but the habit. Saving is not about being rich. It is about being ready. Imagine your savings as a shield. Life is full of surprises. A sudden illness, a job loss, an unexpected bill. If you have no savings, these events can break you. But if you have a small safety fund, you stay calm. You can face challenges without panic. That calmness is the first sign of financial maturity. Create something called an emergency fund. It should cover your basic expenses for a few months. This fund is not for investing. It is your safety rope. It keeps you from falling when the market or life becomes unstable. When you start saving, divide your money into simple parts. One part for your daily needs, one part for your short-term plans, and one part for your future investments. This balance gives you peace of mind. Many new investors make the mistake of mixing these parts. They invest all their money at once. Then, when they need cash, they sell early and lose profit. Do not fall into that trap. Remember, patience begins with preparation. Saving also gives you confidence. When you have a cushion, you are not scared of taking risks. You can invest calmly because you know your basic needs are already protected. This calm mind helps you make better decisions in the market. Do not wait for the perfect time to start saving. There is no perfect time. The best time is today. Each day you delay, you lose the chance for your money to grow. Small savings made regularly can create big results through time. That is the secret of every successful investor. If you ever feel saving is hard, remember your reason. Think of your dreams. Think of the peace you will feel when you have control over your money. Saving is not a burden. It is self-respect. It is saying to yourself, I value my future. Once saving becomes a natural habit, you will feel ready to invest. Because investing without saving is like sailing without an anchor. But when your savings are strong, you can face any storm. In the next chapter, we will learn about the basics of investing. We will explore simple words and ideas that every investor must understand before they step into the market. Chapter 4. Learning the Basics. Before you start investing, you must learn the language of the market. Because just like every skill, investing has its own words and meanings. If you do not understand them, you will feel lost. But once you do, the world of investing begins to make sense. Let us start with the word stock. A stock is a small part of ownership in a company. When you buy a stock, you become a shareholder. You own a small piece of that business. If the company makes profit, you benefit. If it fails, you share the loss. Now let us talk about bonds. A bond is different from a stock. When you buy a bond, you are not owning a part of a company. You are lending your money to a company or government for a fixed time. They promise to pay you interest regularly and return your money later. Bonds are usually safer than stocks, but their returns are lower. Another important word is dividend. A dividend is a portion of the profit that a company shares with its investors. Not all companies pay dividends. Some use their profit to grow the business further. Dividends are like small rewards for staying loyal to the company. Then comes the word index. An index is a group of leading companies that show how the market is performing. For example, when an index rises, it means most companies are doing well. When it falls, the market is generally struggling. An index helps you understand the overall direction of the market. You will also hear the word portfolio. A portfolio is simply the collection of all your investments. It can include stocks, bonds, funds, or even real estate. Your portfolio shows how balanced and diverse your money is. Another common term is mutual fund. A mutual fund is a group investment. Many people put their money together, and professionals invest it in different stocks and bonds. It is a simple way for beginners to start without deep knowledge. You own small parts of the total fund. When the fund grows, your value grows too. Now let us understand risk and return. Risk is the chance that your investment may not give the result you hoped for. Return is the reward you get for taking that risk. The higher the risk, usually the higher the possible return. But a wise investor learns to balance both carefully. You may also hear about bull and bear markets. A bull market means prices are rising and people are hopeful. A bear market means prices are falling and people are fearful. Both are natural parts of the market cycle. No market stays happy or sad forever. Learning these basics is like learning the alphabet before reading a book. Once you know the words, you can understand the stories behind them. You can make better choices and protect yourself from mistakes. Do not try to learn everything at once. Start slow. Focus on one idea each week. Watch how it works in real life. Read articles, listen to investors, and stay curious. Knowledge builds quietly, but its power is lasting. Every great investor began with these small steps. They learned what stocks are. They learned how companies grow. They learned how money moves. That learning gave them the confidence to invest wisely. Remember, the market rewards the patient and the prepared, so take your time. Understand the basics before you put your money into motion. In the next chapter, we will explore the different types of investors. Because knowing who you are as an investor will help you find the right path in the stock market. Chapter 5. Types of investors. Every investor is different. Each person brings their own story, personality, and goals into the market. That is why there is no single right way to invest. The way that works for one person may not work for another. To become a smart investor, you must first understand what kind of investor you are. Broadly, there are two main types of investors: active investors and passive investors. An active investor believes in taking control. They buy and sell shares frequently. They study the market every day. They look for short-term opportunities. Their goal is to beat the average return of the market. They spend time reading charts, company reports, and news. They often react quickly to changes in prices or trends. But this kind of investing takes time, focus, and strong emotion control. Active investors face stress because the market moves fast. They can make quick gains, but can also lose quickly if they guess wrong. It is like playing chess where every move counts. Only those who are ready to learn deeply and act with discipline can succeed here. On the other hand, a passive investor takes a calmer path. They believe in the power of time and patience. They buy good stocks or index funds and hold them for many years. They do not chase trends or daily news. Their goal is not to beat the market, but to grow with it. They trust that the market, over long periods, usually rises. Passive investors save time and reduce stress. This approach is simple but powerful. It follows the wisdom of great investors who said, "Time in the market matters more than timing the market." That means staying invested is often better than trying to guess when to buy or sell. Between these two main types, there are also other styles. Some investors love dividends. They choose companies that pay regular income every year. They focus on slow but steady growth. Others like value investing. They look for strong companies that are undervalued, buying them when they are cheap and waiting for them to rise. Some prefer growth investing. They buy companies that are expanding fast, even if prices are already high, hoping for big future gains. Each type has its strengths and weaknesses. The key is to match your style with your personality. If you love studying data and can handle risk, active investing might fit you. If you prefer peace, stability, and patience, passive investing could be your best path. You can also be a mix of both. Many people keep a part of their money in long-term investments and use a small part for short-term trades. This balance gives both security and excitement. No matter which type you choose, remember one golden rule: understand yourself before you invest. The biggest mistake new investors make is copying others. They follow what friends or social media say, but they forget that their goals and emotions are different. A good investor knows their own limits. They know how much risk they can handle. They know how much time they can give to research. And most importantly, they know when to wait and when to act. Once you find your investing style, stay loyal to it. Do not change it every time the market moves. Consistency builds confidence. Confidence builds success. In the end, investing is not just about choosing stocks. It is about choosing the kind of investor you want to become. The one who runs after the market, or the one who lets the market work for them. In the next chapter, we will learn about setting your goal, because knowing what kind of investor you are is only half the journey. The next step is to decide where you want that journey to take you. Chapter 6. Setting your goal. Every journey begins with a destination. Without one, you may keep moving, but never reach anywhere meaningful. The same rule applies to investing. Before you buy your first stock, you must ask yourself one important question: what am I investing for? Your goal gives your investment a purpose. It turns random decisions into a clear plan. It helps you choose the right path, stay calm in chaos, and measure your progress. Without a goal, you may chase profits without direction, and that often leads to losses and regret. Goals can be big or small. Some people invest to build wealth for retirement. Some invest to buy a home. Some do it to fund their children's education or start a business one day. And some invest simply to become financially free, to stop worrying about money. Whatever your goal is, it must be clear and realistic. Start by dividing your goals into 3 time frames: short-term, medium-term, and long-term. Short-term goals are things you want within a few years, maybe buying a new phone, planning a vacation, or saving for a car. For these, you need safe investments that protect your money from loss. Medium-term goals may take several years, like building a house or starting a business. Here you can take moderate risks for better returns. Long-term goals are dreams that take a decade or more, like retirement, wealth creation, or financial independence. For these, you can invest in stocks and let time multiply your money, because time is your best friend in long-term investing. When you set your goals, always write them down. Writing gives your thoughts power. It turns wishes into plans, and plans into actions. Keep that list somewhere you can see often. It will remind you why you started whenever you feel lost or impatient. Now, every goal must have 2 parts: the amount you want to reach, and the time you want to reach it. For example, instead of saying I want to be rich, say I want to build this much wealth in this many years. This gives your mind a clear target to aim for. Once your goals are set, link your investments to them. Each goal deserves its own investment strategy. Do not mix them. Money for short-term needs should stay in safe places like savings or bonds. Money for long-term dreams can go into stocks or funds where it can grow faster. Your goal will also decide your risk level. If your goal is close, play safe. If it is far, take calculated risks. This balance keeps you stable through the ups and downs of the market. Sometimes your goals may change. Life changes. Dreams evolve. Do not worry about that. Review your goals once every year. Make small adjustments if needed, but never forget the bigger picture. Having clear goals also protects you from emotional mistakes. When the market falls, your mind panics. But if you remember that your goal is 10 years away, you will stay calm. You will not sell out of fear. You will stay focused. And when the market rises, your goals will stop you from becoming greedy. You will not buy just because everyone else is. You will act with reason, not emotion. This is the power of goal-based investing. A clear goal turns investing into a journey of purpose, not pressure. It gives you direction, patience, and peace. You stop asking, "What should I buy now?" You start asking, "Does this help me reach my goal?" When your goals and your investments work together, you move with confidence. You no longer react to every noise in the market. You act with clarity. And clarity builds wealth. In the next chapter, we will explore the importance of knowing risk. Because before you earn rewards from the market, you must understand the dangers that come with it. Chapter 7. Knowing the risk. Every investor steps into the market with hope. They imagine profits and growth and a future of freedom. But before the flowers bloom, you must first understand the soil, the risks beneath your feet. This chapter is about the unseen underground of investing, the dangers, the uncertainties, and the lessons. Risk is not a bad word. It simply means uncertainty about what will happen. When you invest, you are choosing to believe that something will grow. But you must also be ready to accept that it may shrink. In finance, risk is the possibility that your investment may fall in value or fail to produce the return you hoped for. Investor.gov+1. Let us imagine you plant a young tree. You water it. You give it sunlight. You wait for fruit. But a storm may come. A disease may attack. The soil may weaken. The tree may not give what you expected. It is the same with investing. Your investment may have promise, but it also carries unseen storms. There are many types of risk you must know. There is market risk. The entire garden may be affected by flood or drought. When the economy shifts or world events shake the ground, many investments drop at once. National Council on Aging +1. There is business risk. One tree may be weak, even if the garden is fine. A company may fail even when the market is doing well. Investor.gov. There is inflation risk. Even if your investment grows, its fruit may be weaker if prices rise faster than you expect. Lloydsbank.com.1. There is liquidity risk. You might need the tree now, but you cannot cut it down because the forest is closed. When you want your money but cannot access it easily, that is a risk too. Finance strategists. Knowing risk is not about fearing forever. It is about preparing to respond. Just as a gardener learns about pests and drought and chooses the right soil, you must learn about risk and choose your soil, your time frame, and your tools carefully. Your risk tolerance is your heart speaking. How much uncertainty can you live with and not panic? If the tree bends in wind and you fear the worst, maybe you planted something too tall for your soil. If you hardly notice and stay calm, you might withstand many storms. Your risk capacity is your wallet speaking. How much loss can your finances absorb without breaking you? Both matter. Investopedia +1. Now let us talk about time. Time is the gardener's best friend. If you plant the tree and walk away for decades, many small storms will come and go, and the tree may grow tall. But if you need the fruit tomorrow, a storm today may destroy it. Thus, risk is more dangerous when your time frame is short. Lloydsbank.com. What do you do with all this knowledge? You build a plan that respects risk. You decide clearly how much you are willing to risk and for how long. You choose investments that match your risk and time. You diversify. You plant more than one kind of tree in different soil so that if one fails, you still have shade. When a storm hits, you will feel the wind. Your tree may bend, leaves may fall. Your investment may fall in value. That is normal. What is not normal is ignoring the wind or pretending only sunshine will ever come. When you understand risk, you don't run away. You stay grounded. You take action when needed and hold when appropriate. So remember, risk is real but manageable. You cannot avoid it, but you can dance with it. You can choose your pace and plans. You can build resilience. And you can grow stronger because you know what you may face. In the next chapter, we will explore studying the company. Because once you understand risk, you must learn to inspect the tree before you plant, its roots, its soil, its health. Chapter 8. Studying the company. Now that you understand the idea of risk, the next step is to study what you are actually investing in. Because behind every stock, there is a real business. A company with people, products, dreams, debts, and decisions. When you buy a share, you are not buying a small paper or digital number. You are buying a piece of that living business. Think of it like choosing a tree to plant. You would not pick a random seed just because it looks shiny. You would check its roots, soil, climate, and age. The same rule applies when you choose a company to invest in. Good investors study before they buy. Studying a company means understanding how it earns money. Ask simple questions. What does this company sell? Who buys its products? How often do people buy them? Can anyone else easily copy what it does? If you can explain the company to a child in one sentence, you truly understand it. If you cannot, you might not yet be ready to invest in it. Next, look at its history. How long has it been around? Has it survived difficult times? A strong company is like an old tree that has seen many seasons. If it has managed to stay alive and keep growing through storms, it may survive many more. Then study its leadership. Who runs it? Are they honest? Do they talk with clarity? Do they act for the good of shareholders or for their own fame? Great leaders are like good gardeners. They prune at the right time. They water with care. They know when to take risks and when to wait. Now comes the heart of study, the financial health of the company. Every company has a report that tells its story through numbers. It shows what it owns, what it owes, what it earns, and what it spends. Learning to read these reports is like learning to read the heartbeat of the business. You do not have to be a financial genius. Just know the basics. Is the company making profit? Is its debt growing faster than its income? Is its cash flow strong or weak? These are signs of life or signs of struggle. Look also at competition. If many others are doing the same thing better or cheaper, the company may lose its place. If it offers something unique that people truly need, it may hold strong for years. A company with a clear edge is like a tree that grows deeper roots, harder to shake. Another part of studying is looking at the future. What direction is the world moving in? Is the company part of that change or resisting it? For example, a company that adapts to new technology and changing habits usually lasts longer. A company that ignores change may fade away. Emotion has no place here. Do not invest because you love the brand or because everyone talks about it. Invest because you understand it, because you have studied and found truth beneath the noise. Patience is your final weapon. You do not need to study 100 companies. You need only a few that you truly believe in and understand deeply. Investors who rush without research lose quickly. Investors who study and wait grow quietly. Studying a company is like building trust. You learn its strengths, its weaknesses, and its rhythm. Once you know it, you can decide if you want to stay with it for the long term or walk away. In the next chapter, we will explore the power of time. Because even after studying the best company, only time can turn your knowledge into wealth. Time is the silent partner of every investor. Chapter 9. The Power of Time. In the world of investing, time is not just a number on a clock. It is the invisible force that shapes everything. It can turn small seeds into giant trees and small investments into fortunes. Time rewards patience, discipline, and trust in the process, and it punishes hurry, fear, and doubt. When you invest, you are not only putting money into a company. You are putting time to work. Time makes your money grow through a quiet magic called compounding. It means your money earns more money, and then that new money earns even more. This simple but powerful idea is the secret behind almost every great investor's success. Imagine you plant a single tree today. It starts small. It does not give fruit in the first season, but each year it grows taller and stronger. Soon, it gives fruits that drop more seeds into the soil. Those seeds become new trees, and after many years, you no longer have one tree, you have a forest. That is compounding. That is the power of time. The problem is, most people do not give time a chance. They plant a seed today and dig it up tomorrow to see if it has grown. They expect fast results. They chase instant profit. But investing is not a sprint. It is a long walk, full of seasons of growth, calm, and storms. In the short term, markets can rise and fall wildly. You may feel excited one day and fearful the next. But in the long term, patience almost always wins. History shows that markets reward those who stay invested through ups and downs. Because time smooths the noise. It turns chaos into pattern and uncertainty into progress. To see the power of time clearly, think of two friends. One starts investing early, even with small amounts. The other waits until later, hoping to save more before starting. Years later, the one who started early often has far more wealth, not because they invested more money, but because their money had more time to grow. That is the lesson. Time is more powerful than money itself. But using time well also means staying consistent. Investing a little every month is better than investing a lot once and stopping, because each small drop adds to the ocean. And when storms come, market crashes, fear, or panic, time helps heal. Markets fall, but they rise again. Only those who wait see the sunrise after the dark. The power of time is also linked with mindset. If you see investing as a game to win quickly, time becomes your enemy. But if you see it as a lifelong partnership, time becomes your greatest friend. Every great investor has learned this truth. The best time to invest was yesterday, and the second best time is today, not tomorrow. Because every day you wait, you lose a day of compounding. Time also teaches humility. You will realize that not every choice will be perfect. Some companies will fall, some will rise. But if you give time enough space, the good choices often outweigh the bad ones. That is why long-term thinking is the shield of a wise investor. Still, time alone is not enough. You must also give it direction. You must keep learning, reviewing, and adjusting. A tree left completely alone may grow wild and weak. But a tree cared for, pruned and watered, grows stronger. So while you trust time, do not forget to stay alert. Keep watching your forest as it grows. Patience is not about doing nothing. It is about doing the right things for a long time. It is about letting time compound your good decisions. And remembering that true wealth does not come from quick wins, but from steady, consistent growth. The power of time turns ordinary investors into extraordinary ones. It gives them calm when others panic. It gives them strength when others quit. And it gives them freedom that few ever find. In the next chapter, we will explore diversifying your investment. Because once you respect time, you must also learn to spread your roots, to grow in more than one direction, so that no single storm can destroy your forest. Chapter 10. Diversifying your investment. When you build a garden, you do not plant only one kind of tree. You plant many. Some give fruit in summer, some in winter. Some grow tall and give shade, while others protect the soil. If one tree dies, the others still live. That is the beauty of diversity. And that is exactly what diversification means in investing. Diversifying your investment simply means spreading your money across different places, so that one loss cannot destroy everything. It is the art of not putting all your eggs in one basket, because no matter how smart you are, or how well you study, the future is uncertain. Even strong companies can fall. Even safe markets can shake. Diversification helps you survive when that happens. Let us imagine two friends again. One invests all his money in one company because he believes it will become the next big success. The other spreads his money, some in one company, some in another, some in bonds, and a little in cash. If the first company fails, the first friend loses everything. But the second friend stays safe. He may lose a little in one place, but gain in another. That is how diversification protects your wealth. Diversification works like insurance for your investment. It does not promise you will never lose money, but it promises that no single mistake will ruin you. It gives you time to recover, to stay calm, and to keep investing. There are many ways to diversify. You can diversify across different companies. You can also diversify across industries. For example, some in technology, some in health, some in energy, and some in food. Because when one industry struggles, another may rise. You can also diversify across countries. Every nation has its own economy, laws, and opportunities. When one country faces slowdown, another may be growing. Global diversification gives your money wings. It makes it less dependent on one land or one policy. Diversification also includes asset classes. That means you do not invest only in stocks. You can have bonds, which are loans to governments or companies. You can have real estate, gold, or index funds. Each reacts differently to changes in the market. So when one falls, another may rise. This balance keeps your investment garden healthy. But diversification must be done wisely. Some people think owning many things automatically makes them safe. That is not true. If all your investments move in the same direction, you are not truly diversified. Real diversification means holding assets that do not all rise or fall together. It is also possible to over-diversify. If you plant too many kinds of trees and cannot care for them, your garden becomes weak. In investing, if you buy too many things without understanding them, you lose focus. A good investor finds the balance, enough variety to stay safe, but not so much that control is lost. Diversification also helps emotionally. When one part of your portfolio goes down, another part going up gives you peace. You do not panic. You do not sell in fear. You understand that it is all part of the natural cycle of growth and rest. Think of diversification as building a fortress. Each wall protects you from a different side. Together, they make you strong against storms you cannot predict. No single wall can do it alone. So diversify with purpose. Study what you buy. Spread across time, sectors, and regions. And then, let time and patience do their work. Diversification may not make you rich overnight, but it will make you steady. It will protect you from ruin. And in the long run, it will help you reach your goals with peace of mind. In the next chapter, we will explore controlling your emotions. Because even the most diversified portfolio can fail if the investor lets fear or greed take control. To master investing, you must first master yourself. Chapter 11. Controlling your emotions. In investing, the greatest battle is not with the market. It is with your own mind. The rise and fall of prices can move your heart faster than any storm. Fear and greed are the two invisible forces that push most investors to make wrong decisions. If you can control these emotions, you can survive almost any market. Let us begin with fear. Fear appears when prices fall. You see red numbers, you hear bad news, and your mind starts whispering, "What if everything is lost?" Fear makes you sell in panic, often at the worst possible time. You forget that the same company you believed in yesterday has not changed today. Only the market's mood has. But fear is powerful. It makes you run even when the danger is not real. Greed is the other side of the same coin. It appears when prices rise. You see others getting rich, and your heart says, "I want more." You buy without thinking, hoping for endless growth. Greed makes you forget risk. It blinds you to warning signs. And just when you think nothing can go wrong, the fall begins. Greed always ends where fear begins. Every investor must learn to balance these two emotions. The best way is through awareness. When you feel fear, do not act immediately. Take a pause. Remember why you invested in the first place. Has the company's real value changed, or is it just temporary noise? If nothing has truly changed, hold your ground. The storm will pass. When you feel greed, remind yourself that no tree grows to the sky. Even the best investments need time to rest. Take profit slowly, but stay grounded. Do not chase every shining stock you see. Greed always promises quick reward, but brings long regret. History is full of examples. In every bubble, from ancient trading manias to modern technology booms, emotion ruled the crowd. People bought because others were buying, not because they understood. When the truth arrived, prices crashed, and only those who stayed calm survived. This pattern repeats through time because human nature never changes. To control emotions, build a plan before you invest. Write down your goals, your limits, and your rules. Decide in advance how much loss you can bear and when you will take profit. When emotions rise, follow your plan, not your mood. A written plan is like a lighthouse in a storm, steady and bright even when waves roar around you. Another way to stay calm is to avoid checking your investments too often. Watching daily movements can create anxiety and lead to bad decisions. Markets move like the tide, up and down every day, but long-term trends matter more. Checking less often helps you see the bigger picture and reduces stress. Also, surround yourself with calm voices. Avoid people or media that shout panic or hype. Their noise feeds your emotions. Instead, listen to wise investors who speak with reason and patience. Their calmness will guide your own. Meditation and reflection can also help. Many successful investors practice stillness. They take time to think clearly and avoid reacting quickly. Silence often brings clarity. Finally, remember this. Losing money temporarily is not failure. Reacting in panic is. Missing an opportunity is not failure either. Chasing it blindly is. The market will always test your emotions. But if you can stay balanced, you become stronger with each storm. Controlling your emotions is not about being emotionless. It is about feeling the fear and greed, but not letting them drive the car. You can notice them, smile, and still choose logic over impulse. That is the mark of a mature investor. In the next chapter, we will explore building long-term habits. Because controlling emotions is just the beginning. True success comes when discipline becomes a habit, and patience becomes your nature. Chapter 12. Building long-term habits. The market rewards patience, but patience is not a single act. It is a habit built over time. To become a true investor, you must turn wise actions into daily rhythm. Something you do not think about, you simply live it. Success in investing is not about a single smart decision. It is about the small right choices repeated again and again. Let us begin with consistency. Consistency means showing up for your goals even when you do not feel inspired. Investing regularly, month after month, builds a foundation that no sudden luck can match. It is like watering your tree every day, not just when the weather is perfect. Many investors fail because they start strong and stop early. They forget that wealth grows slowly, quietly, beneath the surface. It needs time and constant care. Another habit is discipline. Discipline means following your plan even when emotions scream otherwise. It means not buying more when greed rises and not selling in fear. It means trusting the system you built, your study, your rules, your limits. Without discipline, even the best strategy fails. With discipline, even an average plan can win over time. Saving is also a habit. Before investing, you must learn to save regularly. Treat saving as a duty, not a choice. Each time you earn, set aside a portion for your future self. The more you practice it, the easier it becomes. And soon, saving feels natural, like brushing your teeth or taking a walk. A steady saver always finds opportunities when others struggle. Learning is another habit every investor needs. The world changes. Markets evolve. New technologies, new risks, and new ideas appear. Those who stop learning fall behind. Make it your habit to read, to watch, to listen. Learn from both success and failure. Even your own mistakes are teachers, patient, honest, and unforgettable. Tracking your progress is also a healthy habit. Write down your goals and review them once in a while. Check if your investments are still aligned with your dreams. Do not react to every small change, but keep an eye on the bigger direction. When you see your own progress over the years, you build confidence. You realize how far you have come. Gratitude is a rare but powerful habit. Be grateful for growth, for knowledge, even for lessons learned through loss. A thankful heart stays calm during storms. It sees investing not as a race, but as a journey. This mindset gives peace, something more valuable than money itself. Simplicity should also be part of your routine. Do not chase complex strategies or secret shortcuts. The best investors keep things simple. They buy what they understand. They invest regularly. They hold patiently. That is their habit, and it works. Avoiding noise is another habit to build. Every day the world shouts, this stock will double, that company will fall. Most of it is noise. Do not let it control you. Choose what to listen to. Silence is a stronger teacher than chaos. Balance your life while you invest. Do not let the market consume you. Spend time with family, explore hobbies, and stay healthy. Money grows best when the mind behind it is peaceful. A tired or anxious mind makes poor decisions. Building long-term habits takes time and honesty. You may fail some days. You may feel lazy or distracted. That is normal. What matters is returning to your habits again and again. Every time you return, you strengthen your roots. In the end, wealth is not built by chance. It is built by character, by the quiet power of good habits. These habits protect you when emotions rise, when the market shakes, when others give up. They keep you grounded, patient, and focused on the bigger picture. In the next chapter, we will explore learning from mistakes. Because no matter how good your habits are, errors will happen. But a wise investor knows how to turn mistakes into lessons and losses into wisdom. Chapter 13. Learning from mistakes. Every investor, no matter how wise, makes mistakes. Even the legends of the market have stories of loss. But what separates a true investor from a failed one is how they respond to those mistakes. Some people hide from them, some blame others. But the wise ones study them, learn from them, and grow stronger. Mistakes in investing are not signs of failure. They are the tuition fees you pay to the school of experience. Every wrong decision teaches a right lesson if you are willing to listen. The market is a great teacher, but it only teaches those who stay humble enough to learn. Let us begin with the most common mistake: acting without understanding. Many new investors buy a stock because someone said it will rise. They follow the crowd without knowing what they are buying. When the market turns, they panic. They sell at a loss. Then they promise never to invest again. The lesson here is clear: never invest in what you do not understand. Knowledge protects your money more than luck ever can. Another mistake is impatience. People enter the market expecting quick results. They forget that every great tree took years to grow. They want to double their money in months, so they jump from one stock to another, chasing excitement instead of stability. In the end, they gain nothing but stress. The lesson is patience. Time rewards those who wait and punishes those who rush. Fear and greed create their own set of mistakes. When prices fall, fear whispers, "Sell now." When prices rise, greed screams, "Buy more." Both lead to emotional decisions instead of logical ones. The lesson is control. Stay calm when others panic. Stay cautious when others celebrate. Your strength lies in balance. Overconfidence is another trap. After a few successes, investors start believing they cannot lose. They take bigger risks, ignore warnings, and forget that the market can humble anyone. The lesson here is humility. The moment you think you know it all, the market will remind you that you do not. Some investors also ignore the power of diversification. They put all their money in one company or one idea because it feels safe. But no company is perfect forever. The lesson is protection. Always spread your risk so that one bad season cannot destroy your whole garden. There are also mistakes of silence, doing nothing when action is needed. Sometimes people hold on to bad investments for years, hoping they will recover. Hope is not a strategy. The lesson is clarity. Know when to let go and move your energy to better soil. But the deepest mistake of all is not reflecting. Many people make errors and move on without asking why. They repeat the same choices again and again. To grow, you must pause and review. Write down your decisions, your reasons, and your outcomes. Over time, patterns will appear. You will see your strengths and your blind spots. That is how wisdom is built. Mistakes also build emotional strength. They teach you to accept losses without losing confidence. They teach you to stand again after falling. Every fall makes you more careful, more aware, and more patient. You begin to see losses not as endings, but as lessons. And slowly, you stop fearing mistakes altogether. A wise investor once said, "Success in the market is built on a mountain of small errors well studied." That means your path to mastery is not perfect performance, but continuous learning. Each time you lose, you gain understanding. Each time you fail, you build resilience. That is the true profit, the growth of your mind. So embrace your mistakes, write them down, learn from them, and move forward with more clarity and strength. In the next and final chapter, we will explore becoming a true investor. Because learning from mistakes is not the end of the journey. It is the beginning of wisdom, the mark of someone who no longer reacts to the market, but moves in harmony with it. Chapter 14. Becoming a true investor. To become a true investor, one must evolve beyond the desire for profit. Money is important, yes, but wisdom is priceless. The market rewards not the clever, but the disciplined. Not the emotional, but the calm. Not the lucky, but the prepared. A true investor is not someone who predicts the future, but one who prepares for any future. They understand that markets move in cycles: optimism, excitement, greed, fear, and despair. While others dance to the rhythm of emotion, the true investor stands still, patient, observant, and ready. To reach this level, one must first conquer the inner enemy, the restless mind. The real battle of investing is not against the market, but against your own impulses. When fear whispers to sell and greed tempts you to buy more, your discipline becomes your weapon. A true investor does not follow the noise. They follow their plan. Every great investor builds a philosophy, a personal rulebook written with experience. For some, it is value investing, buying strong businesses at fair prices. For others, it is growth investing, believing in future innovation. But regardless of style, one thing remains constant: clarity. They know why they invest, what they invest in, and how long they are willing to stay. The true investor studies before acting. They read financial statements the way a doctor studies reports. They ask, is this company healthy? Does it have strong leadership? Can it survive a storm? They invest in businesses, not in stocks. Because behind every share is a story, a vision, and a group of people working every day to grow. They also understand the role of patience. Compounding, the eighth wonder of the world, works slowly but surely. A rupee today can become thousands tomorrow if you let time do its work. The true investor does not disturb the process. They let their money grow silently, like seeds under the soil. Risk management becomes their second nature. They never invest what they cannot afford to lose. They diversify across industries and geographies. They keep an emergency fund so that they never have to sell in panic. They see safety as strength, not weakness. Most importantly, a true investor learns to detach emotionally. They treat their portfolio like a business, not a playground. When the market crashes, they see opportunity. When it rises too high, they act with caution. Their emotions do not control their actions. Logic does. They also give back. Because true wealth is not measured only in numbers, but in impact. They invest in people, in knowledge, and in the future. They mentor others, share lessons, and help new investors avoid old mistakes. Generosity becomes their final return on investment. Over the years, they realize investing is a mirror of life itself. It teaches patience, humility, courage, and faith. It rewards those who think long-term, stay honest, and keep learning. And that is the ultimate transformation, from a trader of stocks to a student of wisdom. Becoming a true investor is not about timing the market. It is about mastering yourself. Once you do that, every rise and fall becomes part of your growth story. You stop chasing quick profits and start building lasting value. And one day, you look back, not at the money you made, but at the wisdom you earned. Because in the end, the greatest investment is not in stocks or gold or real estate. It is in your own mind. Once that grows, everything else follows. Chapter 15. The Investor's Legacy. When the journey reaches its final chapter, it is no longer about wealth. It becomes about meaning, about what your journey has taught you and what you will leave behind. Every true investor leaves a legacy, not of money, but of mindset. Because the real treasure is not the fortune you accumulate, but the wisdom you pass on. Money can be spent or lost, but knowledge multiplies forever. The investor who once began with curiosity now becomes a guide. They have made mistakes, faced losses, seen victories, and learned lessons. They have watched the market rise and fall like the tides of time. But through it all, they discovered something deeper: the art of balance. They now understand that life, like investing, is about cycles. There are seasons of abundance and seasons of scarcity. There are moments when everything shines, and moments when everything fades. But the wise investor never stops believing in renewal. They plant seeds of hope even when the soil seems dry. An investor's legacy begins with integrity. They teach the next generation that wealth without ethics is emptiness, that profit without purpose is short-lived, that every investment must serve not just oneself, but society too. They show that the truest return is found in creating value for others. They inspire others to think long-term, not only with money, but with life itself, to build relationships that last, to nurture ideas that grow, to invest in health, in kindness, and in peace of mind. Because the richest person is not the one who has the most, but the one who needs the least. Their legacy also carries humility. They remember the days when they knew nothing, when they made their first mistake, when they first learned patience. This humility keeps their heart open and their wisdom alive. They never act like masters, but remain lifelong learners. And one day, as they look at their journey, they see it all clearly. The fear of the first trade, the thrill of the first gain, the sting of the first loss, the comfort of experience, the peace of understanding. It all comes together like a story, complete, balanced, and beautiful. They realized that investing was never just about markets. It was about mastering the self. Every price fluctuation was a test of emotion. Every risk was a lesson in courage. Every profit was a reward for discipline. And every loss was a reminder of humility. So, the legacy they leave is not a secret formula or a shortcut to wealth. It is a philosophy. Be patient. Be humble. Be consistent. Be kind. These 4 principles become the compass for generations that follow. They also leave a message. Do not chase riches. Chase wisdom. Because wealth without wisdom disappears, but wisdom creates endless wealth. Build your fortune, but let it serve something greater. Let it create freedom, not greed. Let it open opportunities, not walls. In the end, the investor's legacy becomes timeless. Their lessons live on in books, in stories, in the hearts of those they mentored. Their discipline inspires new dreamers. Their humility keeps others grounded. Their courage reminds the world that the market is not to be feared, but to be understood. And as the final thought echoes, money will fade, trends will change, markets will rise and fall. But the spirit of a true investor, calm, wise, and hopeful, will remain eternal. Because investing, when done with wisdom, is not just a path to financial freedom. It is a path to inner freedom. And that is the richest legacy one can ever leave behind.